What up, what up, what up? This is going to be a video on fair value gaps, the importance behind them, how I like to use them, why we use them, all that good stuff. So, what is a fair value gap? I would like to call it a liquidity void. So similar how liquidity is viewed. That's where orders are residing. That's where markets want to target to take out all those orders, to execute these orders. And at that certain price point, this is like kind of literally like it would be where price range where it's kind of like there are no contradicting orders. So if we see a big move up, we are seeing that move in the first place because there is no sell orders through that price range. And that's where the imbalance is. That's where the fair value gap would be, because there needs to be some sort of rebalance. As I mentioned in the last video, some of them, there's two types of fair value gaps. There's an inversion, and then there's a regular fair value gap. So let's start to go over some examples. Also, another important thing, what you want to be mindful of, as I explained in the last video, once liquidity is swept, here's a perfect example. Once an important liquidity is swept, the most recent fair value gap you never want to use. If this was our highest draw on liquidity and price comes to that point and starts to break down, although you see a fair value gap here, you never ever want to use it. It will 9 times out of 10, I don't want to, nothing's predictable in the market. Market moves however it wants to move, depending on what's going on, depending on what news, what current state of the market's in, and all that other stuff. You never ever want to take a random fair value gap, okay? And this is the perfect example as to why that is. So, as you could see here, because price had an obvious draw, there were no pauses in between here to here, okay? Price pushed past this without any other opposing order or price point, okay? So that's like you and your buddy agreeing to get something, and you don't get it before your buddy does, right? And now you have to pay extra, like a pair of shoes or a pair of Jordans or something that you guys wanted, like something that becomes valuable, let's say at a different time, but when it first comes out, it's cheap, right? From here to here, price pushed past and we didn't get in, right? Like this is how like the markets would work. I'm just giving you an example. Let's say Chase and JP Morgan, or JP Morgan and Wells Fargo got in this much, and TD missed the move. TD would call, let's say, Chase and JP and try to push the price point back, because they know people like retail traders that don't really know what's going on, who entered blindly over here, or would think to enter here again, would be like, okay, I'm just going to enter when price comes down here, because look, we broke past this support, this resistance area, and we're going to buy in. And then institutions are like, you know what, let's dump so TD Bank can get in here as well. So this would be our rebalance. But because we have the major draw on liquidity that swept, this now becomes an inversion. An inversion is just an opposite of price hitting this point and reversing back to go higher, because we agreed on this being the cheapest point in this price point, and it rebalanced a liquidity void. Liquidity void would be these right here, sorry guys, would be these 2 points being swept. Had we not swept the high over here, price would reverse back up, and that being that it did, it inversed. And what do we have here? right? We have a sweep of these lows. Okay, so let me explain how to draw them. So whenever you see a gap in a price point, here's another one. You have to have context into why you would want to use them. Here's another one. So what you want to do is you want to take from whatever gap you have. It has to be clear cut. These 2 points can't touch each other. If you have a point that goes past here and touches this point, that's not a valid one. See how you have from here to here, there's no touch between this candle and this candle? That's where you would want to draw. You would want to take your box tool, draw from this point of the high to this point of the low, and wait for price to come into. I have these dotted lines here. I highly suggest that you use it like that, exactly like this. I have a middle line because that's the 50% mark of this gap. Okay, so I use that kind of as a tool. I always wait for a price to tap into the 50% mark to start looking to enter a trade. So now that we have that out of the way, let's use some examples of a clean fair value gap. We have this, and we have this. Okay, let's just draw the box. What do we have here? It doesn't always have to be to the 50. You'll get a little higher, but within due time you'll understand how to trade them exactly. But we have price go to the highest point, tap into some form of manipulation, price closes, we have a gap between this price point and this price point. Price pushes back once more, continues lower, takes out this low, pushes back up, pushes lower, takes out this, pushes lower, takes out this, pushes lower, and then as you can see, that's how we're generating liquidity. We try to go up once more, and it becomes very simple once you could spot it out. But as you can see, why these are very important, it's just rebalancing price, and that's how we could use our fair value gaps to like look for trades. There's like resting orders in these areas. They're not like reversals. So if we see market trending higher and higher and break higher highs and higher lows, we are looking for bullish ones, right? And vice versa, used as a continuation. They're essentially like a 3 candle pattern, which, as I mentioned, would look like this. 1, 2, 3. You have this price point here and this price point here, and no connection between, and we just have this gap down, so it would be 3 candles. You don't want to ever use more than 3 candles. Anything more than that will just it's not a valid one. They're just resting orders. The issue lies within those fair value gaps, which execute purely off of just a fair value gap getting hit and without a reaction. That's something you definitely don't want to do. You want to wait for a reaction within that. Like I said, that's why, as I mentioned, I wait for the 50% point. It's just easier that way. It's kind of like a discounted even more. Like once you wait for the 50%, the dashed line in between. Yeah, you would want to wait for a reaction or scale down to a lower time frame and see a break of structure. We'll go over break of structure as well in the next video. And you want to see the change in that market structure after we have a break of structure. And if it's to the upside, we would wait for a break of structure, obviously to the upside. Once we see a fair value gap close above a lower high, which would be the break of structure, because now we have a new high, and then once a high closes above that high, we would have a new higher high. And we would enter once we get the tap back into the fair value gap. I have all these notes. I wanted to write them down, so just so I know how to explain it to you guys in simpler terms. Essentially, with imbalances, once you get a liquidity sweep, a break of structure, and market dumps, and it doesn't give us a good risk to reward, we would want to wait for a better trade. A better trade would be to go and wait for your liquidities to finally be swept and scale down to a different time frame. So in this case, this is a 4 hour. Let's go to a 1 hour at this price point. Okay. Being that this was the low and these are the candles that took out the low, this low that was taken out is closed by a candle high. What do we have here? We have this gap here. Price pushes past a little bit, but because this is our new swing low and we have liquidity that's swept and closed in the opposing candle, this now becomes our new price point and where price can reverse. And as you can see here, price comes past the 50% mark of the box, the fair value gap, and we get a solid price push up. And that would be our entry, our rebalance in this area. Or here's another way to look at this exact area. What do we have here? We have this gap here that is fully committed to a different outcome. So now this becomes our inversion. So on inversions, what you want to wait for is if we're choosing to go to the opposite side because we have this liquidity that's being swept. As I said, you don't want to use one that's being made after a complete important sweep of a liquidity. You never want to trade, because look, if you entered here, right, you would have had some draw, like some profit, but if you would have held thinking that price is going to go, like, let's say down here or even lower, you would have got taken out at some point, you know. So being that this would be our inversion, you would want to always wait for price to close solidly outside of the box. In this case, even if you like set your order here because you have a little bit of a retracement, that would have been perfectly fine because your order would have tapped you in here and you could have, you know, however, you could have targeted this liquidity, this obvious liquidity, and that would have been your trade. So remember, guys, let's write this down for you as well. FVG would be a fair value gap that consists of 3 candles with a gap. Like, obviously there has to be a gap between 3 candles. I don't recommend, don't use like as I said, once major liquidity is swept, we don't want to use the fair value gap that's created right before the sweep. Okay. Also, IFVG is a inversion. Excuse me. an inversion fair value gap. We use inversions once an important liquidity is swept. For a reversal, key point in IFVGs is to wait for candle to close outside of the gap. Okay, you guys can screenshot this. All right, fair value gap, that consists of 3 candles with the gap between candle 1 and 3. Once major liquidity is swept, we don't want to use the fair value gap that's created right before the sweep. And an IFVG is an inversion fair value gap. We use inversions once an important liquidity is swept for a reversal. Key point in IFVGs is to wait for a candle to close outside of the gap. Okay, once you have a closure outside of the gap, that would confirm to you that we do have a full reversal, plus with everything else, once your liquidity is swept and everything else. That's about it for fair value gaps right now. We'll move on to break of structures and order blocks. We have, let me see what else I have here. I can explain to you what an SMT is. Let's see what I have written down here. Let's see what I have here. Yeah, I'll make a part 2 to liquidity as well in the next video, but for right now, this is so far what I have for you guys. We'll go over SMTs. I'll make another liquidity part 2. What else do I have here for you guys? Let's see. Yeah, I'll go over this in the next video.